is CGTN, China Global Television Network.
With concerns rising about slowing growth in key economies, including China and the EU, and the wider impact of the trade war between China and the US, financial observers expect global growth to decelerate in the coming year. What are the risks that growth will be driven even lower? Are emerging markets in recovery? And how is the rest of the world reacting to China's slowdown? To discuss these issues and more, I'm very happy to be joined in the studio here by Charles Dallara, former Managing Director of the Institute of International Finance. That's our topic. This is Dialogue. I'm Yang Rui. Welcome to Dialogue, sir.
It's a pleasure to be with you today, Yang.
First of all, I believe all of the participants, either guest speakers or observers, audiences in China and around the world will be asking the same question. How would you, an expert of financial studies, assess the financial risks in times of deceleration?
The risks are clearly rising. And I think, unfortunately, you are right to point out these risks as US and China grapple with these very difficult trade, and not only trade, but investment issues. But also, for reasons unrelated to this, other parts of the world economy are also slowing, especially the European Union. This all does raise the question, can we get through the next 2 years in the world economy without a recession?
Why do you ask the question in the framework of the next 2 years? Is that because of the presidency of Donald Trump?
No, it's because my telescope isn't so long. I think we have to acknowledge that it's very difficult to anticipate economic developments in the Chinese economy, the US, or globally for very far into the future. So I try to look out 12 to 24 months. It so happens it does coincide with the next election cycle in the US.
Economists, Chinese foreign alike, look at economic growth on 3 stages: immediate, midterm, and long-term. So let's focus on the immediate threats that we face in balancing the world economy. What do you think of the alleged conspiracy of a currency war? Since the US dollar was actually separated from gold standard in the early 1970s, and in fact, many said the US dollar has actually lost its leadership since then. What do you think of the influence of US dollars in global transactions?
Well, I follow the currency markets quite closely. For quite some years, I was responsible for all currency policy in the US government at the US Treasury Department. Certainly, the US dollar has lost some of its weight, lost some of its gravity as the center of global currency, center of global finance. But I don't think it's been very dramatic. The Chinese currency, of course, is gaining in prominence and in use. But as long as we stay short, as long as the authorities stay short of full convertibility, this will constrain the role of the Chinese currency. I am not so concerned about a currency war. I believe the Chinese authorities understand they need to move carefully with the currency today. I also believe that the US realizes that you don't solve trade problems through a currency war. I spent many years working on coordinating policies for currency stability, and I believe this is what the US and China should work toward in the future.
Major currencies the world over are used for 3 or 2 major purposes. One is, of course, forex reserve, and the other settlement of our transactions. Now look at European concerns. Since President Trump decided to reverse the Iran nuclear deal, they decided to set up their own SWIFT mechanism in settling their deals, perhaps with Iran. What do you think of the European concerns and the American advocacy for unilateralism, putting America first, but the Europeans said, no, we don't want to be lectured about what should be done in rebalancing our trade?
Well, I think at a time when the world is focused on U.S.-China tensions. It's very interesting that you bring out an area that I think also should be a matter of concern for us. Those are the tensions between the U.S. and the EU. And to be honest, I believe that hopefully in the not too distant future, if we see an agreement emerge between the U.S. and China, that attention will turn then to some of these growing frictions between the U.S. and Europe. I am concerned about this effort to circumvent the U.S. policy on Iran. I'm not saying that either the U.S. or the EU is right, but this move by Europe is quite a remarkable move in the face of the U.S. and is unlikely to work very successfully in my view. I think more broadly, Europe has been struggling for decades to create its own currency alternative to the dollar. As a young man at the U.S. Treasury, I remember the first discussions, some of the first discussions about creating the euro. They took place when the U.S. dollar was very weak in the late 1970s. Now we have the euro. And the euro has been only a partial success, however, because it has constrained the growth opportunities for some of the southern European countries, and it is part of the structural problems that Europe faces today.
What do you think of the solidarity of European Union or even the Eurozone itself in question at this moment, with Italy signing BRI after President Xi Jinping visited Rome and after he had the global governors meeting with Angela Merkel and chairman of the European Commission. So impact of Brexit would also add to the uncertainty that you're going to have more of such a disintegration of European Union.
I'm afraid you may have picked the right word, disintegration. I would use a similar word, a synonym, fragmentation. Mm-hmm. I think that solidarity, at least in the short run, is not what we're going to see in Europe. Unfortunately, I think we're going to see Europe pull apart in other ways. I'm quite concerned about some of the moves in some of the European governments, such as Hungary, to a lesser extent Poland, to move away from some of the value structures that have been embedded in the European Union for many, many decades, from some of the open society issues there. But I also think that it speaks again to the problem of creating a common currency without a common fiscal policy, without a common tax policy. They have only gone halfway. And if Europe does not find the basis to consolidate more integration, I'm afraid the alternative is not stability, the alternative is disintegration.
What you said reminds me of what former top banker of China, Mr. Zhou Xiaochuan, said about financial risks and volatility in the wake of the 2008 financial meltdown. He said strongly that we need a common currency above the sovereignty of a certain nation state, such as special drawing rights, a basket of major reserve currencies, so that we would not pin our hopes only on one single world currency, the US dollar. What do you make of the impact of such remarks? Of course, it's a long way to go.
I have huge respect for Governor Zhou. I think he's one of the great financial leaders of the world over the last 3 decades. And I understand this frustration. Actually, I did my doctoral dissertation on special drawing rights. And the IMF created these in the 60s and the 70s as an alternative to the dollar, but it has never blossomed. It's like a flower that somehow could not open up in the springtime. And so I'm afraid that the idea of the special drawing rights becoming a legitimate alternative is not a very compelling idea. I think more importantly, the US and China, Japan and Europe, with the US and China at the center, should try to coordinate macroeconomic policies so as to produce greater currency stability rather than try to focus on a long-term opportunity of creating an alternative.
In fact, China has made its own efforts, such as the establishment of AIIB and perhaps the New Development Bank of BRICS economies to diversify our forex reserves and to diversify channels of investment, such as the BRI. Yet at the same time, there are new signs of volatility for emerging markets and G20, most of the developing countries. What do you think of, say, our efforts to build multilateral financial institutions instead of relying only on the World Bank and IMF, the product and legacy of Bretton Woods system?
Well, I think I understand why China is taking its initiative to create, in some cases, its own institutions like AIIB. It's going to be interesting to see how this develops, and I think China has done a good job. I think the leadership of AIIB, for example, Jinli Chun, has done a good job of reaching out and bringing other countries into the fold, so it's not seen just as a China operation. No. I think also the BRICS Bank, run by an Indian friend of mine, it's also a credible institution. But I hope that China doesn't lose sight that what may be even more important than this, and this is not just for China but the US and Europe, is to adapt the global institutions to new forms of leadership and new areas of focus and priorities to ensure that these institutions are not rusted anachronisms of the post-war era, but that they can be innovated, they can be updated, they can be re-energized. This is what I would like to see the G20, China, the US, and others work upon.
Can you elaborate a little bit more about the macroeconomic policies that need to be coordinated between major economies today, so to avoid, taking unilateral actions to rebalance, for example, the US dominance in the world financial system?
Well, I think there again, while I understand the motivation of President Trump to strengthen the US economy through this focus on our industries, our workers, I think that the only way this can be done successfully in the long run is through better coordination, not only of our own economic policies internally, and that includes better management of the fiscal deficit than we are doing today, but I also think it will take fiscal, exchange rate, and monetary policy, and even structural policy coordination among the big economies. I would like to see the evolution of a G2. Maybe these trade talks are not only going to be about competition, adversarial relationships, strategic competition, maybe they're also going to create understanding and trust and the basis of working together on global issues. This is not out of the possibility that 5 to 10 years from now, when there is a problem in another emerging market, when there is a problem in the global economy, when we see the next version of something like Brexit, that the first step is US-China talking about it. This is what I think could be done in the future to help stabilize and build a more dynamic global economy. It sounds naive today, but it's not.
Thank you so much. One gets nowhere if the couple, like the United States and China, would only view each other as adversaries. We may not see each other eye to eye on the same page, but we are in the same boat to share the same future. You are watching Dialogue with Mr. Charles Dallara, former Managing Director of the Institute of International Finance. We'll be back in a short while. Please do come back and join us. Welcome back, sir.
Thank you.
Charles, with the growing pressure of the trade disputes between our two biggest economies, there is a growing concern as to when and how China could possibly further open up its capital account. Now, the convertibility of RMB and allowing foreign financial services to have more shares in our financial market would, of course, be the centerpiece of international observations. What do you think of the policy options that the Chinese authorities are likely to take to cope with the emerging crisis between our two countries?
Well, I think that it's somewhat inevitable that over the years ahead that China's financial sector and the financial flows in and out of China, the renminbi, will be liberalized. And I would like to see this happen sooner rather than later. I believe that this will lead to a better and more efficient allocation of resources within the Chinese economy and help produce an even more dynamic economy. Today, the structure of China's financial system has grown. It's become certainly more substantial, more important in the global scene, but it is still dominated by a handful of still largely state-owned banks. I remember you mentioned earlier Governor Zhou Xiaoshuan. I remember when he gave a speech at one of the conferences that I hosted years ago, talking about the importance of inviting foreign participation into the shareholdings of these banks in order to help boost the efforts to improve risk management, to improve transparency, to improve governance. That has made some headway. But I would say now it's time for China to consider a more substantial liberalization so that there could be more even playing field for foreign financial institutions in China, and also a significant reduction in the role of state owning and controlling these institutions. I think that China has such an important role in the global economy that the only way the resources of China can be more efficiently allocated is through market mechanisms and good sound regulation, and I think this could play a role in that respect.
Obviously, more Chinese observers would agree that further opening up of the financial market and financial services in China would help avert a trade war between the two countries. But what are the obstacles that need to be removed for the U.S. financial services, such as insurance companies, to make their way into the Chinese market? And in what way could we possibly avert dangers and challenges that we had back in 1998 when we had the financial crisis in Asia, because many of the local currencies in Asia were pegged to the US dollars, and therefore when speculative funds withdrew from the individual economies in Asia, we had this financial meltdown. It seems that there is a financial crisis every 10 years. Is that the curse, cyclical curse?
Well, I do understand the concern, and I remember some of the strains in the Chinese economy in those points. But I do think that one of the hurdles that needs to be removed is the lack of open, dynamic competition in the financial sector. And I believe that if more Chinese entrepreneurs could move competitively into the banking and finance sector, if there were less government ownership and control of the large financial institutions, and more competition and a level playing field with foreign financial institutions, I think you would start to see capital and credit allocated in more efficient fashion in the Chinese economy. One of the obstacles clearly is what happens to the future of the state-owned enterprises. Now, it's not for me to tell the Chinese government how to manage this process, but I'm encouraged when I hear the Prime Minister, the Premier, and the President talk about reform in this sector, but sometimes I have the impression that the reform is not moving as rapidly as it could be, and I think reform of SOEs is going to be critical. Improved regulation is the last part of this that needs to be strengthened. I think the regulatory systems in China have improved, but I think more can be done.
We stand for kind of a PPP, public-private partnership. And this might be a mixture that does not necessarily dismiss the legitimacy of SOE. And in times of crisis, let's go back to what happened in the 1930s when the economic crisis prompted FDR to adopt New Deal. It means Keynes interventionism. It means more of the intervention from the government. So there's good reason for the Chinese authorities to step in strongly and say, look, the strong hand, the visible hand of the government is badly needed. What do you think of the association and relevance between FDR's New Deal and the measures that are being taken and rolled out by the Chinese authorities to iron out the differences and to hopefully survive the crisis?
You know, I think that you make a very valid point. But to me, the point is more related to policy intervention rather than government ownership. I would draw a distinction there because I think
that's a very interesting,
even with
interesting
FDR,
view.
I think that there are times when government has to step in and step in quite actively. I believe that in the spring of 2009, just to bring it forward, not only during the Great Depression of the 30s, but in the spring of 2009, it was right for the G20 and individual governments, including China and the US, to stimulate their economies and to do it aggressively. You may remember the US actually ran up a fiscal deficit to 10% of GDP in less than 2 years to try to provide some new energy to the US economy and the global financial system. At times, governments have to operate, and they have to operate decisively. I was part of the Treasury Department led by Secretary Brady that dealt with the Latin debt problem by telling the banks, you have to write off a large portion of your loans to Latin America. We need to turn the page. It's time. There are times when governments have to take strong actions, but I think those times should be resolved, should be reserved for times of stress, and not be part of an ongoing ownership structure. So that's the distinction I might make. And I think in the long run, I think China has benefited so much from the dynamic growth of the private sector here. Chinese entrepreneurs are every bit as competitive and innovative as American, and maybe in some sectors even more so, but they need to have the room to breathe.
Chinese entrepreneurs do deserve credit for their entrepreneurship and trailblazing spirit, particularly in creating incubation for high technology, digital technology, et cetera, even in countries of BRI. Having said this, they need to also cope with a rule-based world. Look at the wake-up call of ZTE. That's the first battle of the trade war, if it could be called the trade war between the two biggest economies. There's no doubt about that. Let's look at the issue of debts. We not only have the issue of local debts in China, but also the alleged debt trap in developing countries where China makes heavy investment in the building of infrastructure. What do you think of, first of all, local debts? Because we are running sort of a default economy, and we have a lot to learn from industrial nations such as the United States. Debt ratio to our GDP remains lower than even India, but I'm not sure about the same issue in the United States.
Well, let me start, if I may, on a point you made in the lead into this about rule-based system. I think China is at the point where it has so much invested in the global system that it can no longer operate with kind of a pick and choose approach toward the global order, the global rules. For many years, I think China developed its economy and decided that there are certain rules we will play by, and there are certain rules we will do our own way.
Common but differentiated regarding climate change pact.
Yes,
so that's a principle, one of the principles that the Chinese government adheres to during the process of integration. Do you question this political wisdom?
Well, I think today we see the challenges China faces on the environment, and they're substantial.
Because we are still awash with the bitter memories of a shock therapy that took place in the Russian Federation in the wake of the Cold War, and that was a bitter lesson. The Chinese are still trying to figure out how to avert a similar crisis, a repeat, yes, a cyclical repeat.
The former Soviet Union could not hold a candle in terms of its underlying economic strength was very small compared to the Chinese economy today. My only point would be that I think it's time for China to embrace the global system, work to amend it, use its leadership skills to amend it, and then I think help defend the global system. This is, again, it may be an optimistic view, but I think it could happen in the future. On the issue of debt, I am concerned that the entire world has drifted into more debt over the last decade. I mentioned the stimulus of the US economy. It was necessary, but was it necessary for so long? Today, our national debt is approaching 100% of GDP. It's worrisome.
And we are only 68%.
I know, and yet there are problems. I think China has to be much more transparent in the way in which debt is issued at the local level by local corporations and local municipalities. This system is too opaque. It is not well understood by Chinese investors. You create these special purpose vehicles. They're sponsored and underwritten by the banks. The investor may think that he or she is buying something that is guaranteed by a municipality or a province. In reality, it is not.
Charles, are you aware of a landmark piece of legislation that the NPC, National People's Congress, our top legislature, passed in the just concluded annual session, the legislative session, the approval of the foreign investment law? And the very first important part of this piece of legislation was about how to ask local authorities in China not to bend international laws to suit their individual conditions. That would threaten to abuse the foreign investment law. Of course, this law was somehow allegedly approved under the pressure from the US government.
Well, I think the Chinese government is moving to try to deal with your problems here. And I think it's quite impressive to see some of the moves that are being taken. But I would hope that China would also move into a more sustained process of deleveraging the debt in the economy. That needs to happen gradually. It cannot happen abruptly. You can't simply turn off the credit spigot. But I think the shadow banking system has created more problems than people fully understand. I know my friends at the PBOC and the CBRC have been concerned about this for some time. I think their concerns are legitimate. I think that we need to have, in China, a much more transparent financial system.
And part of the transparency, I'm afraid, Charles, is let SMEs enjoy equal and easy access to loans instead of the preferential policies that the SOE boasts of. The last question, Charles, is very much about the alleged debt trap. That's a theory first built up and put forward by Indians, and then it was quickly adopted by Americans to accuse China of, trying to bring those countries that enjoy our investment under our control. I mean, this is a nasty conspiracy theory from the Chinese perspective.
You know, I'm not so concerned about any one notion of a debt trap. I've spent a good bit of my career working on sovereign debt problems. And I've seen so many different countries fall into a debt hole. It wasn't necessarily a trap. Sometimes they dug the hole themselves. For example, 5-6 years ago, I spent the better part of 2 years negotiating Greek debt restructuring, the largest debt restructuring in history, because they got in over their heads. I spent many years working with the Latin countries. I think that each sovereign debt situation is unique. There are no standard rules of the game. I'm afraid that those theorists and those economists and the debt trap issues, in my view, are not understanding the reality that sovereign debt is a question of confidence. It's also a question of market confidence, and it's a question of rebuilding confidence if you let it get into trouble. I think that I don't concern myself with a debt trap for China. I think that China can manage its debt, but I think it needs to focus on this and not allow credit to be extended arbitrarily simply because it's a state-owned bank and a state-owned enterprise, and it seems to be an evergreen relationship.
Charles, you know, I'm not so surprised about your sound knowledge on the Chinese economy and how it was run over the past 4 decades since we decided to open ourselves up. Let's look at what former Premier Zhu Rongji did to list the non-performing loans in the stock market to fix the problem of triangle debts. That could provide us with some of the inspirations from the past. And China is always a country that is blessed by our heavy sense of history. With that, we come to the conclusion of this edition of Dialogue with Charles Dallara, a financial expert. I'll see you next time. Goodbye.